Good evening to everybody. I hope everybody can hear me well. Today we'll start first our attempt to make our webinar in English for our friend. So let's repeat. Everybody can hear me well. Thank you. I'm glad to hear. Okay. Today we're going to talk about the present market situation. So this will be short webinar about the present market state, and we're going to talk about how to define the risk in the market, in the present situation. So, as we can see today, market is in the uptrend. So, first of all, I would like to find out about your market skill. Are you newbie here, or you have some experience in trading stock, or you're just a beginning? Because it will be important for me to build our conversation in the direct way. As you can see today, the market is now in the uptrend. So, but some traders see the risk at the moment. Even if market is the uptrend, we have a lot of risk now in the market, because we can see the different just a moment. I have some problem with the microphone. Can you please confirm that you can hear me? Okay. Just put the plus in the chat. Okay, let's continue. So if you see that the market in the uptrend, you need something to break this uptrend. So actually, normally we're doing with the normal volatility in the market. So when the market is fluctuating the normal deviations from the standard trend. So when traders see the possibilities of the market can penetrate some level of resistance, support and resistance, so volatility starts to rise in the situation. So we have a special sign that such things can happen in the future. So for example, let me show you. Let me show the trend. Okay. So this is the standard deviation, for example. Market is going the upway, but this deviation is the normal. This is a lower resistance line, this is the upper resistance line. So this is a normal deviation. When the market sees the possibility that this can be break, traders start to hedge their positions, for example. When they can see and see that market perspective is very well, so market will continue this way. So if we have the possibility that this order will be violated, so traders who have the big position in the market start to hedge their position. That's what now we're talking about, that we have some risk in the market in the present moment. We are not going to talk about which way the market will go. We can tell only that some possibility of the big movement can be seen by other traders. I think I'm clear here. Okay. How can we see it? First of all, this is a liquidity trap, so-called liquidity trap. So what is going to happen when we see that liquidity trap is in the market. Other traders start to distribute stock with low liquidity. These so-called penny stocks. They'll start to get rid of it because they can sell it only in the up market. This is stock normally have very low daily volume. In this case, if you have a very big position, long position in the market, in the up market, so you can sell it only when somebody is buying. If you have a big position, for example, in market is going down, everybody going to sell. In this case, you are not able to find any buyers. And this is a very big problem for you in this situation. So, first of all, people start to get rid of very risky positions in the market. So this is the so-called penny stocks. When we're talking about the market, we are not talking about the S&P, for example, Dow or Nasdaq alone. So we should take different markets because different index, for example, have include different companies. For example, Dow include very blue chips and very stable position, very stable companies with very solid fundamentals. Yes. If you take the Russell 2000, for example, we have a lot of small companies here. And let me show this. For example, sorry about this. Let me show Russell 2000. So as you can see, we can see the weekly chart here. Russell 2000 is in the range at the moment. Let me show the S&P, SPY, ETF. This is a new high. This is another composite. It's making a new high. So this is a dollar. Almost making a new high. But what is doing Russell? Russell is here. You should remember that Russell includes 2,000 companies. And biggest about the big part of the companies, it's not it's penny stocks, for example. So that's where liquidity trap is going. So it doesn't tell you about the situation with the trend in the future. It's saying that in the moment somebody is going to get rid of the small stocks. You should ask yourself, why are they doing this? The only reason in this situation that they're seeing some risk in the market in the moment because of the liquidity trap. So they're going to get rid of it first because they need the buyers. Understand? So this situation showing you potentially risky situation. This is like a red flag for you in the market. It doesn't tell you about the future position of the market. Next time you can see the situation changes and the market is going up. But in the present, you can see that something going wrong. That is very important. So we are not talking about the direction. The direction is up now. All the trend, all the market is going up. All the index is going up. We're talking about the risk, potential risk in the market. That is what important. So we do not trade intraday. We do not trade swing. We just trade in position trading. So if we can see the risk in the market, so we should be prepared to change our position in the market. For example, to cover half of our positions here, or to buy another stocks, for example, which would be more risk-free. Okay, so all of your questions would be appreciated. For example, don't be hesitate to ask your questions here if something is not clear for you. Okay? So this is the first situation. Second situation. We have, for example, bond market. Yes? And bond market with different risk. For example, we have corporate bonds and we have treasuries, for example. Yes? So normally, if you buy the corporate bonds, you are buying more risky stuff. Because the risk that corporate come to the bankruptcy is very big comparing with treasury. Yes? So that's why corporate bonds give you big rate of return comparing with risk. And normally the normal market is a good market, so traders prefer the risk because they see that in the future perspective will be well. If they can see some trouble forward, so they will change their attitudes and going to switch to the treasuries. Even that rate of return is much more smaller comparing with corporate bonds, for example. So what we can see here, for example, if we take the spread between the treasuries and junk bonds, so-called junk bonds, let's take, for example, so we just take this one. So if we take the junk bonds in minus treasuries, we can see that the spread is going down. If you take, for example, $30-year treasury bonds, we can see that it's rising more than, for example, $10-year treasuries, and 5-year treasuries. You should ask yourself why it's happening. Why somebody is buying 30-year treasuries and putting down the yields. So that's all talking about the risk in the market. Another one, this is the put-call ratio. For example, takes a option market. You can see the situation, the put-call ratio is going up at this moment. So in this situation, somebody's buying the put more than the call options. All the situation tells you about the risk, potential risk. Okay. Any questions here? What we're normally doing in the market, so we're going to take the tape reading is our main, let's say, we have two different ways to trade the market. One is the fundamental, another is technical. People always argue about that, well, which one is more important. Somebody is saying that fundamental first, others saying that technical first. Actually, personally, I do not see any discrepancies here. What are the fundamentals way of trading? So, for example, you take the company's prospects. So, first of all, you should be very good prepared, very good trainer, with very good educated analytic. It's not the easiest way to do. It's very complicated question. But you make your decision based upon company's fundamentals. Sometimes, so you actually, if you are not insider, you work with the public information. But when you take information, when you take your logical decision upon the public information, it's not clear when to buy. So let me show you. For example, we have company ABC. This company has very good fundamental information, very good prospects in the future. But first of all, you should know when to buy this. Because, for example, this company ABC at the present moment doing the next situation, next thing. So, you should answer the question, when the stock is going to go up. Maybe it's going from here, maybe going from here. Maybe it's going up in 1 year later. Because this stock is the moment, in the state of accumulation. Let's take, for example, Tesla. Let's see the monthly chart. So you can see that almost 3 years in this chart. This stock is accumulated. This is a monthly chart. When to buy? Here, here, or here. You will never know only using fundamental information. So this is the state of accumulation. All the time, this company shows sign of good perspective, one way or another. But it starts only from here. Fundamentals will never say when to buy. Fundamentals information is telling you about what to buy, not when. I think I'm clear. That's why I do not see any discrepancies here in understanding what is the more important, fundamental, for example, or technical. So fundamentals information is answering what to buy, and technical when to buy, when to sell. Sometimes it's if you're comparing these two ways of trading, for example, you can see that one information gives you better hints to understand another information. For example, when you see the technical chart, it gives you better idea about what is telling you the fundamental information. The fundamental in the specific company telling you. Okay. Another thing in the market is that sometimes this market under the very big emotional pressure. Let me show you one thing. So we can see uptrend. Market is going up, 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 and then you can see something like this. Because in this situation, any fundamentals news or company news will never tell you that this is possible, for example. But people normally underestimate public reaction of the public on the bad news. When somebody starts to sell, everybody starts to liquidate their position. And sometimes the public overreactions here could be unexpected, if even going. It's the same that what happened in 1929 in the market. This is the three main things in the market. First, fundamental, understanding of the fundamentals of the company and broad market, understanding of the technical position, and understanding of the psychology of the public. All the hedge fund managers and all the experienced traders using this information to establish their position in the market. Any questions here? Okay, let's continue to the present state of the market. So we are not going to discuss any details here because I don't see any questions. So everybody I can see that understand what I'm talking about. I just want to come back to the present state of the market to give you some hints here about the present situation. Because as we were talking before, today earlier, so I can tell you that at the present moment we can see the risk. So why it's happened? Because we've been promised that in September Federal Reserve will reconsider the interest rates situations with the interest rates. So in this case, we can expect some volatility in the market because somebody is saying that this will give a big punch to the economy. Another one saying that this is not a big problem for the market in the present state. So that's why traders expect this volatility in the market and start to hedge their position. Maybe in a couple of days situation will start to clarify. So our position in the market is in the present moment. If we talking about the established new positions in the market, I would say that this is a risky because we need to see the reaction. And I'm showing you what we should see first before we take our position in the market. For example, let's assume that you are trading S&P 50. So this is our resistance, yes? What we can see here? Here we can see sellings. Somebody sells the stock. Somebody sells here. This situation gives us idea that somebody is going to sell stock from this level. If market is going up here, and we can see that somebody is selling from this side, first of all, you should understand how much is going to be sold from this level. If we can see that market is going from this level, making the uptrend and going this way, so this situation is normally should be considered as a weakness in the market. But for example, if we can see that market will give you approaching to this level, will give you nothing from this level, you can see that sellers from this level are not able to sell a lot. They're telling you that somebody absorbed all the sellers over here. That's why this level now is empty and free from the sellers from this level. It depends upon how much will be sold from this line, from this level. So this is the technical situation. If you can see that in the uptrend, from the uptrend, in the uptrend, you can see that no one is going to sell, market should be going up. Okay, but first of all, taking into the consideration the present risky situation in the market, you should first wait for the reaction. Consider how this reaction, is it weakness or is it lack of the sellers here, and only then to take the position. We are not going to about the shortening of the market. We are going to establish new long positions here. Because we have uptrend. If you have uptrend, you should find the place where you are able to buy cheaper. So if you have the trend is broken down and market starts to go in this way, so this is for you to consider about the possible short situation in the market. Not before. Okay, somebody tell me that sometime market is going this way, for example. And this is a very big fall. This is a not trading situation for us. This is a more like casino situation. Sometimes it's possible. That's why we first should consider how much sellers here. Any questions here? You can see S&P 500, sorry. So you can see that comparing with Dow stocks, for example, you can see that market, even if it was weaker than Dow stocks, but anyway, during the reaction, it almost stayed on the same level. So this is the situation would be very important for the market, for this market, for the Russell at this moment. So it's very important penetration on this level. I think it's possible, means that it will come to the sign of strength here. I think it should be, because we have uptrend. If its market is, let me say, very powerful market, so you can see that here sign of strength and retest. This is the up scenario. If you can see uptrust, this is the weakness. So this is the positive scenario, up scenario, this is the negative scenario for the market. Okay. There's possible situation with S&P. Uptrust, fail, retest, and going up. Or we can see, let me show you. So market is going uptrust, sign of weakness, retest, going down. This is a negative scenario. Heavy volume will come with sellers here. Then retest on the weak volume, the market is going down. This is a negative scenario. Positive scenario, sign of strength, retest on the weak volume, going up. But first of all, we should see that indicators we're talking about earlier today will change their behavior, and their behavior will start to be bullish. In this case, it's more bearish than bullish. If you take the all indicators together, for example, liquidity trap, so traders prefer the risky, risk-free stuff. I mean the treasuries, comparing with the corporate bonds, yes, and put call ratio and so on. So we are not going to run through each indicator. Let me say that we have about 15 different indicators in the market statistically, but we just take the 3 for example. Okay. So any questions here? Okay, if you haven't any questions, so we'll start to finish our today web. Sorry for my English. I hope somebody find it interesting. Thank you. Bye.